Okay, good morning. Okay, good morning. We'll start our lesson today. So today we are going to cover our LO4, which is a learning outcome 4. So please just we'll recap, what we learn. Anything you remember which we learned during our last lessons?
So why do you look like that? What's wrong with you? Hello?
Yes, can you hear me?
Yeah, I can hear you now. You're tired.
Is it background your side is a bit noise?
Don't worry about it. It's just training, right? Yeah, I think it's a bit, the reception is not great.
Okay, so we'll start. So what we learn, anything you remember, Christine? During our last lesson, our previous lesson, do you remember what we learned?
After yesterday, we did appraisal. Message her again today. So, I'll probably speak to her later anyway, and I'll ask her if she got back.
Yes, anything you remember which we learned during our previous lessons?
I think we did appraisal.
Huh?
Appraisal. Yeah.
Okay. So what we learned during our previous lessons?
Hello?
Yes, can you hear me? So during last lesson?
Yeah, I think this is like appraisal.
Yes, we discussed about appraisal.
Yeah. You do like a balance sheet.
We discuss about financial statement. We learn about investment appraisal, where NPV, net present value method. We learn about the budget and the budgetary control. LO4 we are doing now.
Yeah.
LO4 is understand, evaluate the business project. So we need to look around which project we'll invest and why we will invest in those projects, on the basis of investment appraisal, which we will go through. So which will go through strengths and weaknesses of each method, and we'll discuss, the sources of finance. Okay, any question? Hello? Can you hear me? Hello? Okay, sorry, I think so you went offline. We just need to start our lessons today. So up to now we have learned during our previous lessons. So we discussed about one of lesson, we discussed about investment appraisals, break even. We discussed during our one of lesson, we discussed about variances, different variance we have calculated as well, and we finish your according to your assignment the task. We discuss about so during our first lesson we discuss about management accounting and financial accounting, difference between these two. We discuss about accounting systems. We discuss about data and information, where we can get the data, sources of information, We discuss about why management accounting and other accounting we need to keep the record. We discuss about revenue management. We discuss about a bit, during our first lesson, budgeting as well. Then during our second lesson, we discuss about investment appraisal, few method. During third lesson, we discuss about, so we covered task one, we explain, and I already discussed you during our second lesson. I already discussed with you different costing techniques as well. Then we calculated the variance, difference between budgeted and actual. I already send you the templates as well, so please we need to really use within your assignment as well. And task three, which I already explained you about year one, year two, the time value of money. And during our last lesson as well, we discuss about, and we need to calculate ARR, which is called average rate of return, payback period, and net present value. And other is IIR, so internal rate of return, which we're supposed to further go through today our lesson as well, because all your assignment is based on these. So you have in your assignment three tasks which we're supposed to address, and we cover all your learning outcome, four learning outcome within three tasks, so which we're supposed to go through. So one of your fourth learning outcome is all about, which we are going to discuss about the sources of finance, where we can raise the money, internal or external sources of finance. Internal could be within our organization, by if we have any spare asset, we can sell it and we can raise the money from it, and that money we can use for a different sort of businesses. Like, if we have a spare building we're not using in a business, and that spare building, the asset, we can sold it to generate the money. If we have a spare stock, we can sell that stock. We can use the money which we'll get, by selling the stock or inventory, which we can use it to use in a business. Other time we have, a lot of invoices from our debt collectors, which is mean, the people to whom we sold our goods and they not make the payment, and that payment we can receive in future dates. So we can look around those, that's called sources of finance, which we can raise the money by discounting our invoices. So that these are the internal and external sources of finance. There are the various other external sources of finance which we can use them to raise the money. It could be a debt financing. Debt financing is mean, we can um, raise the money through issuing to borrow the money from the banks. So debt financing. So we'll go through these today lessons, and I'll explain you further investment appraisal methods as well, which we cover few, but we need to go through all. So according to, it's a huge area of discussion in your assignment point of view as well, which is investment appraisal. So next we'll discuss about sources of finance. Debt is something which has to be repaid. It could be short term, medium term, and long term. Short term debt, medium term, and the long term. Short term normally is considered 1 year, under 1 year. Like could be overdraft, sometimes we use from the bank, that's called debt financing as well. Medium term could be the loan from 1 to 3 years repayment, which we have to within. Or long term, when we borrow money from the bank, is more than like a mortgage, 25-year loan against the mortgage, and it should come under the debt finance. So then when we are looking the short or medium term debt, it could be trade credit, bank credit facilities, bank loan, debt factoring, where we can discount our invoices and the foreign invoices. Those we have invoicing discount, and debt factoring is sort of, is same sort of stuff, which we'll go through. Is only the term and condition could be different. Hire purchase, normally we can get the cars and various other things on a hire purchase. And leasing, there are two types of the lease. One is called finance lease, other is called operating lease. So finance lease, and from the day first the title of the asset will stay the person who's getting the lease. Like, if we as a company, we are getting the lease, the title will be, asset will be ours. Like you're getting the car, you're buying a car on the finance lease. So from day first, car is our car and we have to maintain it. We can say it's my car, it will be title, DVLA, logbook will be on our name. So that's a finance lease. So only we need to pay, including interest and repayment amount, everything we have to pay. But when we have a operating lease, so we're just paying the proportion of the interest, to use like a rental. So the asset won't be our, the maintenance, and normally the company who give us the car, they will maintain it. Like, the various company, they offer 12,000 lease, agreement under the operating lease, and we're paying the fixed amount for it. So that's the difference between. And in terms of the tax rate as well, operating lease is we consider as expense for the business, and then the finance lease from the day first we are putting in the balance sheet as asset of the company. So that's the big difference between finance and operating lease. So next we're looking. Hello.
Hello?
Hello, welcome back.
Yeah, sorry.
So we are discussing today sources of finance. I already recorded for you as well. So will go through. We can raise money through debt. They're called debt financing, internal or external source of finance where we can raise the money. So today we are covering LO4, which is understand to evaluate the business project, which we'll go through. Already discussed in the previous lessons as well, because of course this is quite mixed, topic which is cover your different tasks within your assignment, which we'll go through. Now we are discussing about the sources of finance where we can raise the money.
Okay.
So it could be internal, it could be external. Internal, if we have any spare asset, any spare building, anything, we can sell it to raise the money.
Okay.
And external, it could be bank loan. We can issue shares to the public to raise the money. So we'll go through different sources of finance now. So we are discussing now debt financing. That is something which has to be repaid. Debt financing could be short term, medium term, and long term. Short term, normally within a 1 year, like overdraft facility from bank, that's come under short term. Medium term could be within 1 to 3 years, and the long term is more than 3 years. Anything we borrow, our finance is more than 3 years, we can call long term finance. So medium term, short term, and long term, that could be. And these are the different types of trade credit. We can, if we are buying or purchasing something, the supplier can, credit 90 days credit. We can pay within 2 years time, when we buy things, things from them. Bank credit facility, bank can give us credit, for 90 days, overdraft or various others. That's come under the normally is a short term. Bank loan is a long term. We can borrow money from the bank. Debt factoring, we can factor is a private, the company, those can, or if we have an invoices, we is supposed to receive money from our customer, and those invoices we can discount them, and we can go in the various companies and we'll say that money we're supposed to receive from customer, they will pay us within 6 months, so please, we need some urgently. Can keep our invoices, they can collect, from customer directly, and they can pay us money. All sort of debt factoring and invoice discounting is almost quite similar thing. Hire purchase, we can buy things on hire purchase sometimes, and that's a higher, we are using and we are paying rental fees on it. Hire purchase could be machineries or building can do on the hire purchase agreement. Then lease, lease is a long term normally. Leasing could be finance lease and finance lease when we'll buy any cars, like, finance lease. If it's a finance lease from day first, we can say is our car, and DVLA to the on our name as well. That's called finance lease. When is operating lease? Operating lease only if mean the asset won't be our asset, we are just using and we are paying charges. We are paying charges for use that those assets, So that's
Yeah.
called a finance lease. So there is a
Okay.
difference between finance lease and operating lease. So trade creditor, like I explained you, bank facilities, bank loan, debt factory, invoice discounting, hire purchase, leasing. So these are different sort of sources of finance under debt financing. So
Okay.
then next we looking will the sources of finance. Mortgage is one of debt factoring as well. Like mortgage is a long term. Term loan can be 5-10 years.
Yeah.
Bond is normally is a piece of paper which is written on, like when we borrow £100, we can give £100 worth of papers to someone, but they give us £6. But after 5 years, when they give us paper back, and we can give them £100. So that's normally is called bond. Bond could be secure against our asset. If we have a
Yeah.
company building 1 million, we can issue 1 million bond.
Okay.
So debenture is a sort of loan as well, but normally you have a fixed rate of interest. Then
Okay.
next is a convertible loan stock. We have a stock, we borrow it. We can say we against the loan we have this stock. We can pledge it. So that's it called convertible into the loan stock. Our loan could be convertible into the shares. Shares is mean the company shares like ordinary and the preference share. The loan could be convertible. Some loans we borrow from the bank, and now bank can get our shares of the company, and we can pay dividend to the bank. So that loan could be convertible. Sale and lease back agreement, that could be under the debt financing as well. That's mortgage, term loan, and bond is a long term contract. Bondholder and the company could be 7 to 10 year maturity. Involve risk of reducing restriction. Different sort of uh, loan have a different sort of risk. When we if it's a bank loan, if we don't pay on the certain date, is a more risk. The company could be collapsed. Need to be look around. Okay, next we looking equity. Equity financing. We can raise money through equity. Equity means share capital. So we can raise money through equity financing.
Mm-hmm.
con- Contribute to a company by its shareholder, contributed by the shares we can issue, and we can raise the money from our shareholders. That's it called equity finance. Equity means shares.
Okay.
And a key feature of equity capital, there are no fixed charge, no repayment is required. We only pay dividend if we earn the profit.
Yeah.
But only the problem is the shareholder have a right to vote,
Yeah.
and through their vote, they can change the management. If we will issue too many shares in circulation, so they have a right to kick out management. So sometimes we'll feel scared. We not issue all the shares to the public, so we lose the control. So for the control, we need a mixture of, we have some debt, some equity will issue. We raise some money through bank loan and some money through issue shares. So if
Okay.
we have a too many shares in the circulation, then what will happen? The value of the shares will drop. So we need to be very careful.
Okay.
So then equity capital, all the equity finance reserve venture. Have you heard venture capital?
Who capital?
Venture capital.
I think I have, yeah.
Like EDF going to make a new electricity plant.
Okay.
So that's the venture capital from various country. They are going to be invest as a combined project, and
Okay.
different company they have a money from various investor in their, it's called investment companies, and they
Mm-hmm.
invest in the various project.
Mm-hmm.
Then is a private placing. Private placing is sort of we can look around those who use it, where we can raise the money as well. Okay, some investment market alternative are quoted company. those can provide us loan as well, and they can buy our shares. So these are the different sources of finance where we can raise the money by using this. This all been explained. Yes. So it's a matter of just go through these slides. Any question? Any question?
No.
Okay. These are the different sources of finance. And next, now we are looking investment appraisal. Those we already discussed, but further we need to explain to address our LO, because we're doing learning outcome 4, and we need to learn these about. And during our previous lesson, we discussed about the budget and the costing. We discussed about fixed cost, variable cost, flex cost, and during third lesson we already discussed about budget and cash flow forecast, which I already sent you the templates as well. So this double entry bookkeeping we already learned during our first lesson. Second lesson we learn about these, the capital affected to manage stock. Capital we discussed, and the third lesson we discussed during our last, but we already prepared the variance as well in one of lesson, where I already sent you one question, Yes? Okay. So today we are doing further investment appraisal. So we look now under investment appraisal. What is meant by appraisal? We discussed during our previous lesson. What is meant by appraisal?
Appraisal. Hold on, let me check again.
Appraisal means
it's a meeting in which an employee discusses his or her progress aims, like the end of the year. Is it end of the year?
Yes, appraisal means is checking the performance of the company. So that's called appraisal. So when we're looking performance appraisal, so we're looking these as well. So today we'll checking and we're moving towards internal rate of return. The method we are going to learn internal rate of return. Internal rate of return is the alternative to NPV. We learned about during previous lesson. NPV is called net present value method. So NPV method is examine whether an investment earn on the positive or negative NPVs when discounted at the given rate of interest. So if NPV is a positive, we'll accept the project. If NPV is a negative, we'll reject the project. But under IIR, we're looking to, if my cost of capital is 15%, if I'll borrow money, inflation and all. So IIR, I'm looking more than my cost of capital. If it's more than cost of capital, then I'll accept the project. Otherwise, I'll reject project. So which I'll go through. Any question?
No.
Okay. A project costing £800 in year 0 and expected 4 year, 400 in year 1, 300 in year 2, and 200 in year 3. Calculate IIR. IIR is called internal rate of return. So we can look around. So how many years we are? 3 years we'll get the money from this project. So how much we are going to be the total profit over the 3 years? We are getting 400, 300, 200. So with 700, 900 we are getting, and 800 we are going to invest. So £100 we are getting profit, and that £100 is times by 2 divided by 3 is around 8% return. So IIR we are getting 8%. So other way we can calculate this. We always IIR. We need 2 NPVs. NPVs mean the net present value method. So like in this example, we are going to invest how much money we are going to invest?
Is that 800?
Yes, 800 we are going to invest in year 0. Year 1 we are getting £400. Year 2 we are getting £300. Year 3 we are getting £200.
200.
So I'm discounting my discounting factor which we learn, and I already send you the table as well to discount it on 8%. So
Yeah.
year 1 pound value is a £1. 1 pound value will be 92.6 pence. Year 3 will be 0.857. Year 3 will be, in 1 pound value will be dropped every year. So then can do times by 400 I'm getting, times by 0.926. The £400 value will be £370.
Okay.
Because the things which I used to buy a year before 400, I can only buy with 400, £370 worth of goods. The value of the money dropped.
Okay.
So then I'll add all these positive figures and I'll take out negative figures.
Yeah.
So all my positive 370, 257, 158, my positive figures, and minus the negative. So I'm getting 13.7 NPV. This NPV is my negative NPV. Yes, it's coming negative because my output is more. The money I'm investing, £13 is more than the money I'm covering.
Okay.
So then next I'm doing, when I have my NPV is a negative, I need to decrease my discount factor.
Yeah.
I did on 8%, so now I'm doing 6%. So then again I'm getting money, how much money going out, how much coming. Now I'm doing on 6% depreciate £1 value. So £1 is £1 in year 0, then is by 6% is the value down of the pound every year. Now I can times by, so now £400 value will be £377. So I'll add all my figures positive and I'll minus negative figures. Then my NPV will come 12.2%. So I need to calculate IAR. I need two NPVs, two values. One is on 6%, one is on 8%. Now I have a formula. Formula is IAR equal to A percentage plus capital A times by B minus A and by percentage. And this this come under A minus B, and these all been explained. A is the lower interest rate, which I have calculated 6%. B is a higher interest rate, which I put it 8%. A is a NPV, which is came 13.7, which is a negative figure, and B is B higher interest rate NPV. So I'll put all figures in my formula. A small a is a 6% plus my A is lower interest is 12.2%, and my higher A is 13 points. So I add them all, and then 6 minus 2, and I'll divide them. It's coming my return 6.92%.
Okay.
So 6.92, I supposed to earn 8%. So 6.2 is a lower than 8. So I'm not going to accept my project.
Okay.
Does it make sense?
I don't really understand numbers, but it's okay.
Okay. Just simply you go through the example. This, yes. We need to calculate, and this is a discount factor, is a table we use. Okay. I'll show you table now. So that table we can use it for discounting purposes.
But you know, in task 3,
Yes.
yeah, it's got it's got something that we have to work out.
Yes, task 3.
Accounting return of rate, payback, present value, internal rate of return.
Yes.
And it's got the numbers.
So if I look here,
Mhm.
so I already sent you the answers of task 2.
Yeah.
Task 3, we have a 2 project, yes?
Yeah.
Project 1 and project 2.
Mhm.
So now, how much is money I'm going to invest? 200,000 and 120,000. So
Mhm.
how much profit I'm expecting? Year 1 I'm expecting 58,000. Year
Yeah.
2 there is a loss. Year 3
Yeah.
I'm 4,000, and year 4 I'm getting 14,000.
Okay.
Then year 2, then these, So I'll do,
Mhm.
the money that cost me, that
Yeah.
annual profit I have, I'll this minus this, yes, I'll use discount factor there,
Yeah.
because they said, the cost of capital is a 10%, so I can
Mhm.
use 10% discount factor. Okay, first ARR, I'm going to show you some examples as well, which is called annual rate of return. So what I'll do, I'll solve this question. So during our next lesson, I'll show you as well. We'll do one extra
Okay.
lesson on this topic, okay?
Okay.
That make you sense then, okay?
Yeah.
That's all we need to do. 3
Okay.
tasks there. So first
Mhm.
task you need to write.
Yeah.
Second task we have calculated already these, which I already send you variances, yes.
Mhm.
And the task 3 is the cost of capital, yes.
Okay.
So only 3 tasks we have. So which I'm going
Okay.
to send you separate. Does it make sense?
Yeah, makes sense. Yeah.
Okay. So that's really we need to do. So we're
Mhm.
moving next now in term of learning.
Mhm.
So we already discussed what is meant by budget.
Yeah.
Budget is a financial plan, yes.
Yeah.
Expressed in financial terms, budget
Mhm.
will define the precise target and concerning the cash payment is regarding to sales and detail the stock requirement and specific production. The reason of the budget could be planning coordination. Budget help us to be plan, coordinate, communicate, motivate, and control and evaluation.
Mhm.
The time horizon, the setting of the strategic objective is usually done around every 3 to 5 years. So
Yeah.
we can set the budget is usually done every year.
Mhm.
So target is annual budget, set targets for year for all
Yeah.
level of business. Budget and forecast. Budget is a plan, not a forecast.
Yeah.
So predict budget and rolling budget. Predict budget is a prepared for a particular period of time, and rolling
Mhm.
budget, the previous year budget will carry on adding, few percentages. That's carry
Mhm.
on roll on, roll off, every year.
Okay.
That's the predict budget and continues. Then interrelationship between budget. For any one period, there will be more than one budget. Each one has a related to the specific aspect of the business. We have a relationship, cash budget, balance sheet, and those which we discuss about the profit and loss, how much money we have earned, how much expenses. Balance sheet shows our asset liabilities, and cash flow it shows how much money came in the business and went out of the business.
Yeah.
And we can make budget based on it. So we discuss about the budget could be on the production budget, how much unit we supposed to produce and how much we are going to sell.
Mhm.
Purchase budget, how much stock we require to purchase to make the production. And the cash budget, how much money we will be each month, and if not, where we'll get the money from.
Okay.
So then we can set the budget. Setting budget process is important. It must be approached logical, because if budget is not a logical, where the money will come, how much we'll spend, how much, then we will be under budget. Like, NHS and various other, due to the under budget, we are struggling. The patient is time is increased, nurses. Yes, we need to budget on it. So if we have a right budget according to right level of activity, then will help us, So we can set a responsibility. We saying you have this budget, you need to do this thing. If you don't do it, what will be happen? It will be performance will be measured. You will
Yes.
be given reward against if you perform well. If you not perform well, you will be penalized for it. Communicate budget and the guidance relevant to the manager. Yes, we can communicate these things to the managers. We can identify the key or the limiting factors. Limiting factors mean the factors, those affect the budget or the limitation. What is the limitation? Like we have how many hours labor is available. So how much we are producing, that's the limit. So we need to use it of labor effectively. Shortage of doctors. We have shortage of nurses, but we need to be how we can prioritize. We can like we going in emergency, they put the priority, you're a priority A, B. If you have a very serious disease, life threatening, you will be given priority A. Yes. So nurses more available, those sort of the patient, and then less. So because we have a limited resources and we need to use effectively. Like we have a money, we have a limited resource, we need to use is a urgent needs, we need to meet. Yes, we have a limit on it. So we need to
Yes.
make it effectively. That's called limitation, a limiting factor. We can make the draft budget in different area of responsibility. We can review, coordinate. Master budget mean whole UK budget is a master budget. Then we have all the consular budget and various other, those are the sub budgets. We can communicate again and we can look around here. Incremental budget, the budget which we can increase every year. So budget, every time we making new budget, we're starting with the zero.
Okay.
We're not looking the previous year budget, that's called zero based budget.
Okay.
Activity based budget, if I'm producing 100 unit, if you are in your area is 1 million patient registered patient, in other area 2 million, so your budget will be based on your activity. Yes, if you're dealing with more patient, you will get more. Less patient, you will get less money. So that's called activity based budget.
Okay.
And the variance, we learn about the variance. What is meant by variance?
Variance.
Yes.
Is difference between planned budget and it's different revenues.
No difference between plan and actual. I said I'll supposed to spend £10, but actually spend £12.
Yes.
That's a £2 adverse variance. So if is, I'll say, could be positive and negative budget.
Okay.
So that's adverse and favorable variance. So like material price variance, material usage variance, material efficiency, fixed overhead, and all these are the variances. Just about sale, direct cost and indirect cost.
Yeah.
Actual hours times by the actual rate. That's the rate variance. Efficiency variance could be so how many hours were required, how many times it took. If the person is efficient, will supposed to take less time. Okay, variance analysis. A company makes cabinet and this is example, and direct labor takes 4 hours times by and how much time per cabinet to make, and during the current month we create cabinet, so we can say how many hours were required and how much cost for those hours times by 7. So that's now we can look around my labor rate actual is actual rate I supposed to spend it, and standard rate supposed to be 7, and there is a difference unfavorable. I paid £470 extra. I supposed to pay £7, I paid £7.10. So there is a variance £175 I paid extra. Efficiency variance, I supposed to spend 475 hours, but actually I spend it 4,800 hours, so I spend it 50 hours less. So my standard was 4,800 hours. So that's my rate is 7. So I saved 350 pounds. Right. So if I look overall rate and efficiency, I lost 125 pounds because I saved in term of hours that cost, but I lose 120 in term of the rate because I paid 10 pence every hours extra.
Yeah.
Does it make sense?
Yeah, it makes sense.
Okay, so that's all really we learn about today. We learn about two types of variances. What I'll do now, please you start your question 1, and I already send you the question 2. Yes?
No, you haven't sent it to me yet. I haven't received it.
No, I send you, when we did the task together, where the variance and the cost,
Oh,
we
task
have
2, yeah. You sent me task 2, yes.
Yes, that's the task. And you need to go through the task 1, which is you need to write yourself, like explain the purpose and the requirement of financial record. If you open the lesson 1, I already, and today I already explained you budget and budgetary control as well, which is you said budget is a plan, budget help us planning, controlling, all these sort of things, and you can add the example of variance there as well.
Yeah.
And the costing, we discuss about different marginal cost, absorption costing. So these you just need to write it.
Yeah.
So you just start, task 1. I already send you task 2, just copy and paste the template. You can explain little bit variances and things. And then task 3, I will solve it and I'll send you the example of it.
Okay.
And you can write little bit what is meant by appraisal, what is meant by accounting rate of return. I send you already slides,
Yeah.
Like today we learn about IAR, which is called internal rate of return, which is supposed to be higher than the cost of capital, and that's we already explained.
Okay.
What I'll do then, my numerical bit I will do myself, and you the answers. Okay.
Pardon?
I will send you the answers of it, which will make you sense, and you need an interpretation of it.
Oh, I need to answer what payback means.
Yes.
Okay. And what
Which is
question?
Which is a task 3. You have only 3 tasks, in your assignment.
Yeah. Okay. That's
Any
fine.
Any question?
No. Are we gonna have one more lesson on this?
Yes, I will do recap half lesson.
Yeah.
I'll send you the task, that we'll solve. I'll explain you as well, and then we'll move to other units.
Well, hopefully by our next lesson, I will have it ready.
Sorry?
Hopefully by our next lesson, I will have it ready.
Okay.
Huh?
Okay.
Pardon?
Sorry. Can you say again?
I said hopefully by our next lesson, I will have it ready for you.
Okay. Yes, that's fine. That's fine.
Yeah.
So we'll go through, and then we'll make sure everything covered, and then you start. What you do task 1, huh?
Yeah.
If you do up to next lesson task 1, you already know the task 2.
Yeah.
And that's and then we'll move to task 3, and then almost your assignment will be complete then.
Yeah.
Okay.
So when is our next lesson?
When you think next lesson can we do on Friday?
Friday I'm working. What about Monday?
Oh, that's fine. No problem. We'll do Monday next.
Yeah.
No problem. We'll do Monday next lesson.
Okay then. That's fine.
Okay. Have a nice time.
Thank you very much, Andrew.
Thank you. Bye-bye.
Bye.